This video reviews Toyota's financial results for the second quarter of fiscal year 2026, covering the period from April to September 2025. Toyota Motor Corporation is a Japanese multinational automotive manufacturer, also owns the luxury brand Lexus and Daihatsu, small K car brand. FY2026 second quarter results summary. Toyota's operating income for the first half was 2 trillion yen, a decrease of 18.6% from the previous year. Despite the impact of U.S. tariffs, strong demand supported by the competitiveness of Toyota's products led to higher sales volumes mainly in Japan and North America, which expanded value chain profits. For the full fiscal year, Toyota forecasts operating income of 3 trillion yen, down 29.1% year-on-year. The company is continuing its improvement efforts such as increasing sales volume, improving costs, and enhancing value chain profits. It is also focusing on translating comprehensive investments into improved productivity and returns, with an emphasis on lowering its break-even volume. Regarding shareholder returns, Toyota plans to maintain a stable dividend increase policy to reward long-term shareholders. The full-year dividend forecast is 95 yen per share, up 5 yen year-on-year. As for brand and product strategy, Toyota announced that it will clearly define the roles of its 5 group brands and clarify each brand's direction. By offering a wider variety of products tailored to individual customer needs, Toyota aims to further expand customer choices. In the first half, consolidated vehicle sales reached 4,783,000 units, which was 105% compared to the same period last year, indicating steady growth. Sales of Toyota and Lexus vehicles totaled 5,267,000 units, or 104.7% year-on-year. The increase was mainly driven by strong customer demand in Japan and North America. The share of electrified vehicles rose to 46.9%, compared with 44.4% last year. Hybrid vehicle sales increased strongly in regions such as North America and China, while plug-in hybrid and battery electric vehicle sales also showed notable growth. Overall, Toyota achieved higher sales volumes across major regions, supported by strong product appeal and expanding electrified lineups. In the first half, revenues were 24,630 billion yen, an increase of 5.8% from the same period last year. Operating income was 2,005 billion yen, a decrease of 18.6%, with an operating margin of 8.1%. Net income was 1,773 billion yen, a decrease of 7%, with a net margin of 7.2%. The average exchange rates during the period were 146 yen per US dollar and 168 yen per euro. Overall, while Toyota's sales revenue increased due to strong global demand, profits declined because of higher costs and the impact of U.S. tariffs. Factors that affected Toyota's consolidated operating income for the first half of FY2026 compared with the previous year. Operating income decreased by 458.5 billion yen to 2,005.6 billion yen. The main negative factor was the impact of U.S. tariffs, which reduced income by about 900 billion yen. Other negative effects came from higher expenses and rising material prices, including labor and R&D costs. However, several positive factors helped offset part of the decline. Marketing efforts such as higher sales volume and improved model mix contributed, while value chain businesses and financial services added further support. Toyota also benefited from cost reduction efforts and a recovery in overseas subsidiaries. Excluding foreign exchange effects and swap valuation gains or losses, the company's underlying operating income remained relatively stable, supported by steady cost control and structural improvements, even under a challenging business environment. Operating income by region for the first half. In Japan, operating income decreased mainly due to the impact of exchange rate fluctuations and higher costs, despite stable vehicle sales. In North America, profit declined significantly because of U.S. tariffs, which offset the benefits of strong sales volume. In contrast, operating income increased in other regions, such as Oceania, Africa, and the Middle East. The improvement there was driven by higher sales volumes, better product mix, and continued cost efficiency. Overall, Toyota's operating margin declined especially in Japan and North America. Toyota plans to continue its approach of increasing dividends in a stable and continuous manner to reward long-term shareholders. The interim dividend for FY2026 is set at 45 yen per share, which is an increase of 5 yen from the previous year. The full-year dividend forecast is 95 yen per share, also up 5 yen year-on-year. In addition, Toyota decided not to establish a new share repurchase program for the interim period because it already approved a large 3.2 trillion yen repurchase in June as part of taking Toyota Industries Corporation private. Toyota stated that it will continue to conduct flexible share buybacks in the future, taking into account its stock price and market conditions. Forecast for consolidated vehicle sales for the full year. Toyota expects consolidated vehicle sales to remain unchanged from the previous forecast at 9.8 million units. However, the forecast for Toyota and Lexus vehicle sales has been revised upward by 100,000 units to 10.5 million units, reflecting stronger than expected global demand. Retail sales, including vehicles from unconsolidated affiliates, are projected to total 11.3 million units, an increase of about 300,000 units compared with the previous year. Electrified vehicles are expected to account for 48.9% of total sales, up from 46.2% in FY2025, showing steady progress in Toyota's electrification strategy. Toyota expects particularly strong demand in North America and aims to capture more market share there by leveraging its competitive product lineup. Consolidated financial forecast for the full year. Toyota revised its forecast upward and now expects sales revenue of 49 trillion yen, an increase of 500 billion yen from the previous forecast. Operating income is projected to be 3.4 trillion yen, 200 billion yen higher than previously expected, with an operating margin of 6.9%. Net income is projected to reach 2,930 billion yen, both showing upward revisions. The dividend forecast remains unchanged at 95 yen per share for the full year. Toyota assumes an exchange rate of 146 yen per US dollar and 169 yen per euro for the full year, reflecting the recent depreciation of the yen. Overall, Toyota expects higher profits and revenue than initially forecast, supported by strong global sales, cost improvements, and efficient operations despite the continued impact of U.S. tariffs. Stock price. This chart over the past year shows the stock price in Japanese yen at 3,139 as of November 6. This chart shows the stock price in U.S. dollars at 199.15 as of November 5. After the earnings announcement, the stock price fell slightly, but it recovered the next day. Current PBR is 1.09 and PER is 14.0. Dividend yield is 3.03%. Compared with historical PBR, PER, and dividend yield, these figures suggest that the stock price is a little bit high. However, since Japan's top company offers a yield of over 3%, it is considered a good dividend. Conclusion. Toyota achieved steady sales in the first half, driven by better-than-expected demand and expanding electrified vehicle sales. Although profits declined due to higher costs and U.S. tariffs, the company maintained a solid financial position and raised its full-year profit forecast. Toyota remains focused on cost efficiency and long-term shareholder returns through stable dividend increases and flexible share buybacks. Although profit is expected to decline from last year, Toyota seems to be managing well under the impact of U.S. tariffs.